Welcome to TheoTRADE. This is Don Kaufman. May 15th, 2024. 10 minutes to go to the cash close here on this Wednesday afternoon. The SPOOs, they are a ripping higher, but inflation, that's far from dead. Let me break down some of the trade action that we've seen in this marketplace today and what you can expect, of course, into the remainder of this week. Starting with none other than, as I said, the SPOOs. So the SPOOs right now, SPOOs are S&P futures for those of you that are new, right? So the S&P futures are up some 59 points right now. If you're looking at that like, oh, it's an astounding move to the upside, quite frankly, the SPX was kind of handicapping about a $53 move for the day. So let's jump over to the SPX, and you can see the SPX right now is moving upward about $58. But what's probably the most imperative thing to understand, okay, about where we're presently trading, and I'll close up the left side bar, and I'm really just going to zoom in. This is, of course, this week's expected move. And the reason that I'm actually bringing it into scope, okay, is we're doing, well, precisely kind of what we anticipated. The entire week, right? And that's when I actually show these three lines on the screen. You're like, what are those three lines? Okay, this is the expected move. The central line that I'm kind of highlighting right now, okay, that is effectively where the week started, right? So this is where the week started. This is the upper edge of the expected move, the lower edge of the expected move. This week, the expected move is roughly $67. What are we doing right now? Boom, here we go. CPI comes out, we rip, okay? The most critical thing is when I start looking on an intraday time frame, all we have done after CPI came out. Look, CPI, do you want to say it cooled a little bit? Maybe the month over month might have cooled, but like, the big headline number, 3.4%, came in as expected. And to me, that's still pretty far from cool. I mean, inflation, still, we're not home yet, at least according to the Fed. So the entire trading session came down to, well, we hit the upper edge of the expected move. And right now, we're still, okay, kind of on and in that zone. If you take a really detailed look at this, so the upper edge of the expected move, and again, I really want to denote exactly where it is. It's that 5290, okay? 5290 is the upper edge of the expected move. That's that line right there. And you can see, well, you're like, wow, yeah, but we're 14 handles higher. That is what I would kind of term, okay, degrees of freedom right off this 5290. What is absolutely critical, and what's funny is we were talking about this exact setup last week. I mean, we looked at this verbatim last week, and last week, on Wednesday, I literally talked about it on Wednesday. We came to the upper edge of the expected move. So the entire week came down to what? Okay, breach or no breach, and the breach was very, very mild to the upside last week, but nevertheless, we did breach to the upside. So here we are again, okay, with just seconds to go to the cash close, and we're right on the cusp of where I say a breach, anywhere from about 12 to about 15 points off the upper edge of the expected move. You can actually see the marketplace kind of almost like ignite to the upside, and that's actually caused, okay, by hedging activity. If you think of this, the upper edge of the expected move, that's kind of like the market, it's happy place. Because this is all about gamma risk. This has nothing to do with what do you feel about the marketplace? Oh, I'm very bullish or I'm very bearish. Look, nobody in the professional side cares about that. All they care about is hedging activity. Everybody in the professional side, they're all bona fide hedgers, which basically implies they're not even taking any directional risk out there, right? So what matters to them is you start to get outside this expected move by more than a few points, okay, it's actually going to kick on servers they're going to hedge, and they're going to hedge that move, okay, in the direction of the move. So that basically implies the higher we go, the more futures contracts they're going to have to buy. And you go, well, how did futures contracts get all wrapped up into this? Because the SPX has no natural underlying. There isn't stock to the SPX. The SPX is kind of the mother of all products. Speaking of the mother of all products, if you're kind of curious about the SPX, and when I call it the mother of all products, look, it's a $5,300 product, okay, that's trading 3 million contracts, 3.2 million contracts today. You're like, well, how does that compare to the spiders? The spiders are roughly the same thing, right? Spiders and the SPX. The only problem is spiders, they've done 7.7 million contracts. You're like, well, the spiders are bigger. On the contrary, the spiders are 1/10 the size. The 3 million contracts in the SPX is kind of getting it done. The whole marketplace today might do like, 46, 47 million option contracts. We just showed you where 10 million of them were done. Okay. So all the volume and all the liquidity is pretty much moving through the spiders. Okay. It's moving through the SPX, and that's fine. But what's so important to understand is in terms of like notional value, that means how much capital is actually moving through this beast. Okay. So, the S&P futures, the SPX, the spiders, they're all basically one and the same. And all that anybody cares about right here, right now, okay, is getting their risk mitigated because we could explode to the upside. You would see volume actually kind of, erupt into that. I wouldn't be surprised though if markets, even in an overnight session, pulled back again to the 52.90. And literally that is your trading week. Your trading week is, it kind of breaks down to the idea of what are we going to do, okay, by week's end, right? By week's end, you always have to say, as a trader, you got to say, look, the higher probability is to be inside the expected move unequivocally. And you can see the market's running here just a little bit into the close. But the higher probability is, of course, we're going to end up inside the expected move because an expected move is a standard deviation. The lower probability is to actually breach to the upside. But there's a little bit of a catch-22, involved here, and that's this. If we breach to the upside, okay, which is, as I said, a lower probability. It's a lower probability, but that breach could be absolutely violent. And you've seen some of that trade quite recently. Okay, breaches to the upside, though, not as significant. Okay, but we've seen a multitude of breaches to the upside and the downside. The market is right now what I would term a little bit unruly. Okay, I don't mean right this second. I just mean in general terms in the last few weeks because we're continually breaching, okay, these expected moves. And that's basically trade into the end of the week. Now, there's not a lot, okay, of news and so forth to go on. Okay, when you look at this to the remainder of the week, it's a primary expiration week, but when I open up kind of the end of the week, you still have, okay, about $35, $36 priced in, which it has really been diminished. And a lot of volatility has been crushed out of this marketplace. You can see the VIX back down to the low 12 handle, but volatility has been crushed out of this marketplace. But people, look, that's what you would expect. We just came through CPI, and the market kind of seemed, destined to head higher regardless of what that CPI print happened to be, which, again, in my opinion, the CPI print wasn't at all light. Again, inflation is far from debt. Meanwhile, okay, last thing I want to mention on here is kind of understanding what the market driver happens to be. Okay. And lo and behold, I started looking at like, the advanced decline line. Now, the advanced decline line is good, but it's not correlated, meaning that this is not like, the quintessential all up day. And in fact, when you start looking down the list, some of the usual suspects, the energy sector, okay, hasn't been involved until like the last few minutes. The energy sector has basically been down all day. It's rallying into the close with the rest of the marketplace, but the energy sector hasn't really been involved. The financials, pretty lackluster day, except with the exception of the last few minutes. Look at the last few minutes. We just traded 42.05. Okay, we're up 15 cents in the last couple of moments into here. But it's really, once again, it's all about tech. It's all about tech. NVIDIA came back to life, and I've talked about the one stock market. Okay, Meta, once again breathing life into Meta. Okay, reaching back towards all-time highs in here, and that has once again kind of become the marketplace. So in trade like this, look, it's not exactly exciting. It's not exactly awe-inspiring. The entire trading session today came down to, well, riding the upper edge of this expected move, maybe a little bit of a breach, as I said. Wouldn't be surprised to see us pull back to the 52.90 overnight, kind of tease the marketplace a little bit for tomorrow. But the entire remainder of the trading week comes down to, is tech going to remain relatively under control? Are we actually going to hold the upper edge of this expected move or even see a little bit of a pullback? I would also leave you with the thought that, okay, bonds, Okay, although bonds did rally, it's a little bit lackluster versus what I would have expected with the marketplace being up, to the tune of about 1.2%. Yeah, if inflation is really dead, those bonds could have exploded to the upside. That's something that's actually going to be, opportunistic in the days to come. Much more on that in the next couple of days. There is the closing bell. And yeah, I'll be looking for a couple of trade setups inside of the ZB the next few trading sessions. Thanks everybody for joining us here at TheoTRADE. Have a wonderful evening. Bye-bye.